Before we begin, this video is for educational purposes only and is not financial advice. Always do your own research and consult a qualified professional before making investment decisions. Now, you open your broker, type in the name of one of the most famous ETFs in the world, and you get a message you did not expect. Blocked. Not available to retail investors in your country. If you invest from anywhere in Europe, you have almost certainly hit this wall. Today we explain exactly why it happens and what you can buy instead. Picture this. You have read about a hugely popular American index fund, the kind that tracks the S&P 500. You fund your account, search for the ticker, and your broker will not let you buy it. No error code, barely any explanation. It feels arbitrary. It is not. There is a specific piece of European law behind it, and once you understand it, the solution becomes obvious. The regulation is called PRIIPs. Packaged retail and insurance-based investment products. It came into force in the EU to make sure ordinary retail investors receive a standardized document explaining what they are buying before they buy it. A plain language summary of costs, risks, and expected scenarios. That document is called the Key Information Document, or KID. Every product sold to retail investors in the EU must have one, following a specific European template. Costs in a standard format, a risk score from 1 to 7, and performance scenarios. An American ETF provider writing documents for American regulators simply does not produce a European KID, and without a KID, your broker legally cannot sell that product to you as a retail client. Large American fund providers file with the SEC. They are not obliged to produce a European KID, and for most, the extra cost of doing so for a non-primary market does not make commercial sense. So the block on your broker screen is not your broker being awkward. It is a legal wall that runs across the entire continent. The solution is a framework called UCITS, Undertakings for Collective Investment in Transferable Securities. It is a European regulatory standard in place since the 1980s, requiring strict rules on diversification, liquidity, and investor protection. Crucially, it comes with the documentation Europeans need, including the KID. UCITS CETs funds can be sold freely to retail investors across all EU and EA countries. Here is the fix. For almost every major index a popular US ETF tracks, there is a UCITS compliant version run by a European or globally operating provider. You are not getting a worse product. You are getting the same market exposure inside a wrapper that European law actually allows your broker to sell you. If you look at UCITS ETFs on your broker, the overwhelming majority are domiciled in Ireland. This is not a coincidence. Ireland has a long-standing tax treaty with the US that reduces withholding tax on US dividends paid to Irish domiciled funds, and being inside the EU, an Irish fund can be marketed across all member states. This has made Dublin the natural hub for European index funds tracking American markets. Here is a detail with real impact on long-term returns. When US companies pay dividends to foreign funds, the US government withholds a portion as tax. Ireland's treaty with the US gives Irish domiciled funds a significantly lower withholding rate than funds elsewhere. Over decades of compounding, that difference adds up. It's why Irish domiciled UCITS ETFs are generally the most tax-efficient option for European investors accessing US markets. When you browse UCITS ETFs, you will see share classes labeled ACC or Dist. ACC stands for accumulating. Dividends received by the fund are automatically reinvested on your behalf, so your unit count stays the same, but each unit grows in value. No cash lands in your account, no decision to make, and in many jurisdictions that means no dividend tax event triggered, which can be a meaningful efficiency depending on your country's rules. Dist stands for distributing. Dividends are paid out as cash into your account, usually quarterly or semi-annually. Some investors prefer this for a regular income stream, or because local tax rules make cash dividends simpler to report. Neither class is universally better. It depends on your income needs and your country's tax treatment. The underlying index and total costs are usually identical between the two. One concern investors have is whether UCITS ETFs cost more than their American counterparts. For the most popular broad market indices, the total expense ratio on a well-chosen UCITS ETF is typically around 0.20% or less. Some flagship funds are even cheaper. The gap versus a US ETF on the same index is not dramatic, especially for core broad market exposures. Here is a practical mapping. For every major exposure you might want, there is a UCITS equivalent, S&P 500. MSCI World or FTSE Developed for Global Developed Markets, MSCI AQLY or FTSE All World for Global All Country, including emerging markets. The index name tells you what you are tracking, not the brand, not the ticker. Two ETFs tracking the same index give you extremely similar long-run returns. When searching on your broker or a fund screener, do not search by US ticker, search by the index name instead, for example S&P 500, and filter for UCITS ETFs or Ireland domicile. Many European brokers also have a filter to show only products eligible for EU retail investors, which will automatically surface UCITS funds. It is worth pausing to appreciate what the UCITS framework gives you as an investor. UCITS funds must diversify. No single holding can dominate the portfolio beyond strict limits. Your assets are legally separated from the fund provider's own money, so if the provider goes bankrupt, your holdings are protected. And that key information document gives you a standardized cost and risk summary before you invest. These are not trivial protections. When a European investor buys a UCITS ETF holding US stocks, those assets are priced in dollars. If the euro strengthens, a euro-based investor gets a headwind even if the US stocks rose in dollar terms. Some UCITS ETFs offer currency-hedged share classes labeled EUR hedged that neutralize this effect for a small extra cost. Over very long periods, currency effects tend to mean revert, so many long-term investors choose unhedged funds. One caveat: fund-level tax efficiency does not eliminate your personal tax obligations. Every European country taxes ETF gains and income differently. Some have a deemed disposal rule, meaning you may owe tax on unrealized gains at set intervals. Others tax accumulating and distributing funds differently. This video cannot cover every country's rules. Consult a local tax advisor to understand what applies to you. A few pitfalls to avoid: do not search by the American ticker, search by index name instead. Pay attention to fund domicile, not just the provider name. Think about whether accumulating or distributing suits your tax situation, and check which exchange your broker lists the ETF on. Buying in a currency different from your account-based currency can introduce hidden conversion costs. Here is a simple framework. Start with the index you want. Find a UCITS ETF that tracks it. Prefer Irish domicile for US equity exposure. Choose accumulating or distributing based on your tax situation. Compare total cost, including withholding tax drag. Then check your local tax rules and buy in your account's base currency. That is genuinely most of what you need to know. It is worth stepping back for a moment. The wall you hit when you try to buy that US ETF is not arbitrary red tape. It is a deliberate investor protection. The EU decided retail investors deserve a standardized document before investing in complex products. You may disagree with the implementation, but the intent, informed consent before you invest, is reasonable. The UCITS framework arose from the same philosophy and has made Europe one of the most investor-friendly regions for cross-border fund investing. Let us bring it all together. US ETFs are blocked for EU retail investors because they lack the key information document required by PRIIPs regulation. The fix is UCITS ETFs, the same index, a compliant European wrapper. Irish domicile is typically most tax efficient for US equity exposure thanks to the tax treaty. Accumulating funds reinvest dividends automatically, while distributing funds pay cash. Your local tax rules determine which suits you, and costs on broad UCITS index ETFs are very competitive, often around 0.2% or lower. If you found this useful, like and subscribe so you do not miss the next episode. We have a free newsletter linked in the description where we go deeper on European investing topics each week. Remember, everything on this channel is education, not financial advice. Do your own research and speak to a qualified advisor if in doubt. I am the European Investor. See you in the next episode.